What's up, guys? Welcome back again. And the information begins. I'll put it this way, guys. Today I'm going to throw a lot of things at you, but it's because of the time that we're in, the time frame that we're in. You need to be well informed of all these things. And again, I'm not a financial advisor, guys. This is just me shedding some light on what I see and how I translate it and what I look for. And that way, that helped make me a much better trader, and throughout my trading career. And again, I do like by following this, that launched me in June of 2021 with basically that gave me the indication. This, what I do, how I do this, is what gave me the tools to go ahead and act on it. And in June 2021, that paid off very, 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 very big for me, especially with that run up, because of this thinking, I went ahead and acted on that. And yes, it was very, very, very gutsy, and it was crazy. I mean, if I was to tell you like in numbers, I don't like to, because it comes off as some form of whatever, flexing or whatnot. So I will keep the numbers away. But I will tell you that I would only tell you this, that how I went in it and how deep I went into it, all in on it. You guys would, anybody who knew me from my inner circle would have called me insane or crazy. But when the gains came back and my theories came to fruition, everyone became my friend. So yeah, you know how that part of life is, guys. So anyways, without further ado, enough of the drama. So we're going to start with this video, okay? We're going to start with one topic. Reverse with repo and reverse repo. Why is this very important? You're going to ask yourself, a lot of people talk about this. Well, not a lot of people, as far as how much or how many people should be talking about this. People just see it as a daily thing and that's it. But let's understand what it is for. So here's the market side, and I will give you a street side after. From the market side of things, basically when the market is in some stress and it leaves liquidity, the Federal Reserve is supposed to be the good guy. So they come in and say, you know what? No, we want to make this a liquid market. We want to help the economy grow. This is why yesterday you started seeing the market rebounding, and today they're saying that this is the reason is because the Feds came out, announced that they're gonna, they hiked the rate and they're beginning to taper. So therefore, the market reacted to the news going up. Now, many YouTubers said it was going to be the opposite effect. Guess what? They were all wrong. Why? Because the market is telling you that when the coexistence of the reason of why the repo and reverse repo coexist is to prop up the market. And through those numbers, the overall system can tell if it needs to continue to do so or not. How? When the banks need money, they go to the central federal bank. And when they go there, the Fed wants to help put liquidity in the market. So what it does is it gives them practically a loan, and in return for liabilities, like basically things that they are collateral. Basically, the bank offers collateral, like a bunch of securities that they hold, a bunch of bonds and stuff like that. And in return, they get all that cash from the Federal Reserve. Now, all that is brand new cash. What that does is when the banks take it or the financial institutions take it, some hedge funds, big ones. So when they take it, that simultaneously, automatically starts dropping the interest rates down in the overall market. So this is why you saw a lot of people were going to reconstruct their mortgages, and redo the whole mortgage, because they would get much better percentages because they were very low, very competitive. And the funny thing is, when the market, the Federal Reserve, came out yesterday to announce that, guess what? Guess what was the first thing to go up? The mortgage and the housing sector, 4%. If you want to fact check me on that, go ahead, search it. You could find it probably in Yahoo Business or anywhere. You might have to dig deep or something to find it, but I'm just telling you this, guys, from what I've seen. So the first thing to go up, or to start to go up, are the interest rates. This is just like this is something that is by default. It has to happen by default, because now we're getting much less liquidity from here, which means this person, the bank, the middle guy, or the financial institutions, wants to hold more to their money and to their cash, because they won't be getting a lot more from where that came from. And they basically, by giving up cash, they will still continue to do business, but under much harder conditions, which means higher interest rates. And we're only beginning. You're going to see more come down as we go down the aisle longer in this, as the Federal Reserve continue to hike rates and to completely, come to an eradication of buying back, or basically to start dumping more and more of their paper, of what they have, basically. So that right there, my friends, was an explanation to you on why you saw why the markets have reacted the way that they did. Now, this second video is going to be how, why are we getting, why do I think that the repo and reverse repo operations were very crucial into our movement, how that relates to us, not just on a general level as far as buying homes, the quality of life, how the market is in general. No, how does that relate to us? And that will be strictly my opinion on that third video. Okay, so much love, bbby Investments.